I'm sure they're bursting with wisdom on the topic of the buyer's perspective. First of all, are there any people in this room who buy credits, quality credits, poor quality credits? I'm not asking you to disclose, no shame here. Heads up, how many of your companies or as investors you... Okay, very few, only maybe 3 hands. And on this stage, how many of you are buyers? Okay, we have a couple, at least 3, half, that's good. How many of you sell and therefore deal with buyers on a regular basis? Okay, there we go. We have some reason to have you on the stage.
Already a good point.
Alexander, how do you see this question? We're trying to turn the lens in a different way and saying, how can we look at this from a buyer's perspective? What is the status of the marketplace? Again, if we talk about buyers, sellers, we need a marketplace, we need price discovery, we need some vague rules of the road. This is a nascent area, but how do you approach it?
So Klarna, I think, has a pretty unusual approach. We're a fintech, a global payments network, and we have a relatively small footprint considering how large of a business we are, about 100,000 tons of carbon. We've decided it gives us a great canvas for an ambitious climate strategy. So what we do is we have a net zero 2040 target.
With a small canvas, but you can paint a beautiful picture.
It's a beautiful picture, indeed. And some of the most beautiful pictures you'll find are quite small canvases.
Mona Lisa.
Exactly. So we have a net zero 2040 target. We do all the bells and whistles around reducing our emissions, etc. But then we also take responsibility for those emissions that we haven't reduced by applying an internal carbon fee to them, and then making contributions to climate projects via something called the Climate Transformation Fund that we have in partnership with Milky Wire. And the key idea here really
is... That's a charitable fund, am I right?
It's a charitable fund to some extent. We do also purchase CDR via it. So there's 3 pillars: decarbonization, nature conservation, and carbon dioxide removal. And the reason I bring this up in the context of CDR is because our approach is what we call catalytic. So we allocate a certain amount of funding per year to CDR. In the last 4 years, it was about 3.8 million in total. And then a expert advisory group makes a decision on where we spend that money with the highest impact for the sector. So we have quite a high risk tolerance and quite a high cost tolerance for what we buy. And the idea is that the CDR space is so nascent that really what it needs is a lot of shots on target, explore different technologies. In many cases, we're the first buyers of those suppliers. So we were among the first, if not the first buyers of Climeworks or Heirloom. So companies that then went on to buy, to do bigger things. But we have purchased from around 27 organizations across different pathways, so biochar, enhanced rock weathering, DAC, etc.
So you spend like a drunken sailor, basically.
We do, indeed. Indeed. This is the beauty of the small canvas.
All right. And but you did find some winners, and we'll hear a little bit more from Climeworks a little bit later. And how do you decide when you talk about high risk tolerance? That means a lot of things also failed. Otherwise, you wouldn't have taken the risk, or it would not be a proof positive of high risk. So what is your decision-making matrix when you think about prospective technologies? Because, I'm on the receiving end. I don't spend money to buy any of these things, but as a journalist, I'm pitched endlessly by it seems every PR agency, venture capitalist, and startup has my email, and they're all bombarding me every week. Sadly, half of them are some variation on a SaaS company, which is all the Silicon Valley knows how to fund, how software and SaaS is going to solve the carbon problem. I immediately hit delete on those press releases. But companies that are actually doing something that involves engineering and the hard stuff I'm very interested in, and there's many of them. So what's your matrix for analysis? How do you think about it?
First, I would like to think my inbox can rival yours with people trying to sell me credits.
Well, of course, you actually have money, so yes. But apparently you spend freely. So.
We do have an advisory board of CDR experts that are actually evaluating them for things like plausibility of technology, then track record of demonstration projects. Then there is, I suppose, an assessment by the experts about what are high potential scale cases, where's the differentiation towards other technologies in the marketplace, et cetera, et cetera. So the expertise, I think we're quite deliberately we're using outside expertise quite deliberately, but the idea is really the framing this all has is use this money in a way that you think is going to stimulate early stage demand. And for a lot of startups, it's also literally just the demand signal that helps them raise their Series A or something like that. So we're trying to play an outsized role. We're not Microsoft or somebody in terms of volumes, but I think we have this catalytic approach that really makes a difference to a lot of the startups.
Okay, well, that's very interesting. So thank you for kicking us off on point. And because our next contributor, Piera, you're not a buyer in the same sense, but you're an important influencer, your organization. People will know the SBTI as a initiative that represents high quality and integrity in this area. And generally speaking, if I understand, and correct me on this, you favor companies that sign up to you agree to do the hard cuts internally first. That is, they take action first. And if there's some balance that's very hard to achieve in the short to medium term, you do grudgingly allow them to get some credits, but you insist on high quality. So take us a little bit through this. What does this mean? Because again, the people you deal with who might be a part of your under your umbrella are buyers. What guidance do you give them? What do you poo-poo and say not allowed? Where do you draw the line? And as head of research, I'm sure you have some metrics around all of this.
Yeah, well, first of all, I mean, I think a lot of the thinking around carbon removal originated from the kind of like the first version of the corporate net zero standard, which is kind of like our flagship standard that has this famous mitigation hierarchy. So company should first drastically reduce their emission and sustain this emission reduction. And then they can also start investing in what we call beyond value chain mitigation activities, such as, for instance, buying carbon credit or also carbon dioxide removal credits. Mm-hmm. So that counts towards their, like, they cannot count as offsets, but they can count as a contribution to kind of like the global transition. And then finally, there is this kind of like final portion, which, as you said, company should neutralize through permanent carbon removal. Now, from when the standard was published, we have done quite some thinking, both in terms of like targeted research, but also stakeholder engagement activities. And one of it is the publication of the Beyond Value Chain mitigation guidance. They kind of like shows all the different activities that a company can take, again, under a contribution framework. Then we published our Scope 3 report last year, where we also try to kind of like look at the different mechanisms and certificates that company could actually purchase in order to kind of like count towards their Scope 3 emission targets. And there was also space for carbon dioxide removal. And so we investigated also, how we could actually make emission fungible to the removal actually of emission. And then finally, in the fall, we also had targeted stakeholder activities, with some of are actually present here, where we kind of like really wanted to engage stakeholders to see, okay, what carbon dioxide removal can play now instead of like in 2050, and how we can actually integrate the evolving space, also CDR, in the standard.
And what did you find out talking to the stakeholders? What kind of feedback did they give you?
So, well, first of all, definitely that it's massively needed that instead of having like a target in 2050, that we actually provide some indication to the industry on start scaling CDR now.
Right.
Definitely also on the need for SBTI to align with existing framework when it comes to quality criteria, for instance, on carbon dioxide removal. And I think there was also a kind of like unanimously a need for like also distinguish carbon dioxide removal credit from other credit, because of course these are much more expensive. And there is a need for making this separation distinction.
Okay, so that's your analytical framework.
Yeah.
We'll come back to you, I'm sure, in the course of our discussion. Let me turn to you, Nicholas. I understand Heineken reaches a part to the carbon market that other beers don't. Is that true? Can you tell us a little bit about how you see this question?
Can you repeat the question?
No, I was just joking. What is your corporate perspective on the buyers? You're sitting on the sidelines waiting for a little more information. What's your?
I will certainly play the prudent role in this panel. Just to explain you, so we were working with science-based target for many years. We have our net zero 2040 targets. And we're slightly adjusted, our glide path, which is we focus first on decarbonizing our 200 sites across the world. Beer is a very local business, so it's brewed in 60 countries. So that's a gigantic task for us to decarbonize all our breweries in the 60 countries. And then we are going with our suppliers on scope 3. And then, of course, in the science-based target manual, there is this part about neutralizing the residual emission. And we interpreted it in the past like it is the last thing to do in your journey. Actually, we start to learn that it's maybe the last, but you should not do it too late because, of course, you need to act right now also to create this carbon storage solutions. But when we went to the market 2 years ago, so our board told us, look, this market is bubbling. There's a lot of emails every day. We should jump into it. So let's buy some stuff. We got a very large budget offer by the board to go and buy. And we started to talk to many partners. And what we saw was a lot of nice projects, very well packaged and well marketed. But the only thing we could find in front of us was pricing. Was the only KPI we could compare all these projects. And then we started to have a bit of a moral discussion to say, what's the economics here? Are we looking to reduce the price and then down the line there is somebody in a farm around the world which is going to be penalized and the capital are going to move to traders? Is it really fair what we are doing? So we had a real doubt that it was the right moment for us to step in. When you are a company like Heineken or Philips, the main thing we have in this agenda is our reputation and our image. We cannot, jeopardize the whole agenda just for a tiny project that creates a scandal in our business. Now, the beauty of being a big group, we discover that wherever we brew beer, we need water. So we have done for many, many years water restoration, reforestation projects for the sake of securing access to water. And we discovered actually we have some projects that can be certified, that can be high quality projects that are on our own land. And that's basically what we are working right now to take the opportunity of what we have in our own network before going to the markets and understanding how this market works. So that's our journey so far. It's not going to be finished. We have a long way to go until 2040.
But is it fair to say that your investments are primarily nature-based projects at this time?
At this time, yes.
Yeah. I'm not so sure our friends at SBTI would approve.
We will discuss with them at the drinks.
Yes, we'll have a picnic under the trees and discuss. Very good. Let's move on. Let's move to our next speaker from Philips, Alexandros. Can you give us your corporate perspective? As a sort of corporate sustainability leader in Europe, what is the view that you have of CDR and the prospect of being a buyer here?
Yeah. We started already the journey back in 2015, where we were one of the first companies to sign the Paris Agreement. And we set shortly after targets for our scope 1 and 2 emissions, reaching also in long-term 90% reduction, scope 1 and 2. And a couple of years back, we also made a 1.5 degree decarbonization commitment for our scope 3 emissions. All in all, from scope 3, when we start measuring scope 1 and 2 and committing to that, we also recognized 2 other categories like logistics and business travel, which we're able to measure in the early stages in the absence of guidance for the other categories. In that sense, we also committed pretty early in decarbonizing the residual emissions of our operational carbon footprint. So scope 1, 2, and the 2 categories of scope 3. Having done so in early stages, we were rather early in the market also to create a portfolio of the majority being avoidances and some removals, and be able to live up to the commitment of being carbon neutral in our operations. So the first priority for us has been and is still and will be in the future to decarbonize. So reduce. If I have 100 euros, it will first go to projects that will reduce my emissions, and then we will invest in mitigating, let's say, the effects of.
Well, let me press on that just a minute before you go to the points 2 and 3 here. In terms of internal signals, because obviously you're a very large company, how do you, if this is your first priority, and which philosophically is the right one, reduce internally. do you use an internal carbon price, or is it a managerial mandate or incentive system with bonuses for reducing carbon footprint? Give us a little idea of how you do it.
No, all of them. So you cannot act on that without have an intrinsic organizational motivation. So if you don't have your board's buy-in, there's no way you're going to be there for success or for the long term. So that means that already from the early stages of looking at the people, planet, profit perspective, before even having all these greenhouse gas protocol guidance, we already started being actively busy to see how we can reduce our impact. Unfortunately, back then, we did not have this carbon accounting for us to measure that. I'll give you an example. We had PVC as material in our plastic cables. We start in the early stages, I think in the 70s, 80s, to find ways to replace that because we know the harm that chlor will have in its supply chain. Now we are a couple of decades further. We have matured much more. There's a carbon accounting. We can translate a lot of the things that we are doing in CO2 emissions. And upon that, we can also take decisions. Now, of course, since finance is very, very important and sensitive matter for a lot of companies, we need to find ways to translate that in a tangible, understandable way for the finance board to deal with that. So there is where the internal carbon pricing comes. And then what you do is you start identifying projects that could help you reduce your emissions. Now, those projects are multi-million euro investments, but then which one do you do first, second, and last? Now, that's where it comes the marginal amendment cost curve, where you compare the gain that you have per euro spent in tons of CO2 reduction, which is far greater than any euro spent in buying carbon offsets. Why? Because it's permanent. So if I choose to modernize a building and decouple from fossil fuel, from natural gas, and electrify that, while I guarantee already since 2020 that Philips is running on 100% renewable electricity, it's a done deal. There's no way of failure there. Where the risks are, as Nicola just mentioned, is in the plethora of projects out there that could cause a reputational damage. So that's the high risk that we have, and we see in the market that we have to be very, very careful and rather conservative, unfortunately, in approaching the market and choosing and cherry-picking the projects that can be put on an annual report.
Yeah. Okay, well, that's good to hear. Despite the interruption from the CO2 being offered to people on stage, incidentally carried in water, thank you for that. I appreciate that. It's very important to get into the culture of a company. As some of you will know, the great management guru, Peter Drucker, famously said, culture eats strategy for breakfast. And so whatever your plans are, unless it comes from the top, unless it's embedded in the DNA of the company to do this, many companies will fail with highfalutin strategies, is our experience over the years. Megan, let's come to you. Tell us about ClimeFi. Some of the people in the audience may not be familiar, although everyone should be familiar with your company, but also what's your interest in the buying side of things?
Sure. Hi, everyone. Megan Hunold. I'm head of partnerships at ClimeFi. And at ClimeFi, we're specialists in permanent CDR assets, we say. And ultimately, what we're trying to do is de-risk this space on behalf of buyers. So that our services include market intelligence, risk assessment, and procurement services. So to date, we have procured across every permanent carbon removal technology on behalf of our clients. So we have a strong perspective as a buyer as to what they're looking for, and ultimately, to your point, how to make this a less risky space to start investing in. And so just kind of picking up, as you just mentioned, the risk piece, I mean, I think that obviously sustainable leaders obviously have to choose between, no one questions, first and foremost, we need to focus on reductions. And that's very much in line with science-based targeted frameworks, which most of our clients have validated initiatives. But right now, I think the key thing is we can't wait. It has to be simultaneous reductions as well as removals, because as we may know, there is a long technology timeline here, and we need the investment now. And by we, I mean the technologies that actually show promise to scale to gigaton levels where we need to be in the next 10 to 15 years. So that's really our North Star, is identifying those projects that show potential to scale. But first and foremost, really working with those buyers that have interest to really help them understand how to engage in this space, from due diligence to really understand what one technology looks like from another. Because within one removal pathway, there's multiple technologies that look very different when you really dig into it. And so I can understand that it does look like a very risky space today. But the reality is I don't think there's any question that this is an industry that needs to scale if we're going to be able to reach our climate targets. And there is a lot of people sitting on the sidelines, and I would like to encourage people to get into the space today, start to get your learnings.
Can we press on that just a little bit? Because you talked about quality and due diligence, right? This is the in the weeds, sort of the nuts and bolts of how one discerns what's a quality credit versus what's not. As we all know, because we live and breathe, and you're in this sector, but also, we read the papers, there has been a corporate retreat from carbon. Carbon markets are in trouble. We've seen a backlash of greenwashing and fears of greenwashing and fears of being accused of greenwashing. Then we saw the green hushing trend, and now maybe it's green wishing. There's various iterations of all of this, and now maybe there's a wholesale retreat from any interest in this area, with the political winds blowing in the other direction in the United States. And so in this kind of complicated arena, when you talk about identifying quality credits, doing due diligence, what can you take us through just a little bit of what does that mean? A company like Microsoft, which is committed not just to net zero, but to net negative lifetime emissions, they have a team of 100 plus experts in-house who do nothing but this sort of thing all the time. Kudos to them, right? Great. And they're obviously very forward-leaning. There's Frontier Coalition. There's some groups that have invested the resources to do this. That's not going to be most companies. They can't afford this. Most companies have a CSO and maybe a couple of others, and they're relying on intelligence from wherever they can get it. And they're also under pressure from the CFO on the financial side, because many CSOs now report to the CFO increasingly, who says these numbers are bogus. Right? The CFO signs up on something. This is the grown-ups table now, and they're not going to accept some consultant's report or questionable numbers. This is going to be a much higher level of scrutiny, and so the game is changing very quickly. How do you respond when you have clients or when you advise your partners how to do this due diligence properly in an era where there's much more scrutiny?
So I would say that one of the first key things is that you really need to have a robust due diligence process, whether you do that in-house with the likes of Microsoft or you outsource that to a third party. And the way we look at it is that first and foremost, we look at the carbon integrity by looking at the minimal, I wouldn't say minimal, but the high standards that you need that identify what is a quality carbon credit, things like additionality, verifiability, net negativity. I think we're all familiar with those. But then taking a step beyond that, because really today, when you're a buyer in this market, you're committing to purchase future capacity of an early stage technology. And so there's other inherent risks associated, most specifically the delivery risk, right? So that's really where you look, that's a financial risk. And so you want to look at that aspect of it, of what does the governance structure look like? What is the cost structure of this company? What kind of technology are they actually implementing? And how many other companies have implemented that technology that we know they will actually deliver the estimated capacity they say they're going to deliver in 2 to 3 years? This is the type of due diligence that we look at, because that is the real financial risk here. So I think that to your point, there is a lot of different things that companies need to look at. And the third thing that really is unique, because there is not one size fits all carbon removal portfolio. Every company has a lot of there's something unique about every company that really, we call that strategic risks. And that really goes to where are your operations? You might have a preference for a certain geographic location based on your supply chain or your actual operations. All of these things come into play to choose the projects that are best fit for your portfolio. And so I kind of, would break it down to those three things: that carbon integrity, first and foremost, the delivery risk, which goes in line with the financial risk of looking at the company as a whole, and finally, those strategic risks that really trying to identify what is a fit for your business.
Great, thank you. That really breaks it down in a nice, structured way. I appreciate that. And I think, in a way, it kind of leads to you, Hussein, because as a company at the forefront, a pioneer in quality CDR and removals, your company is often touted as one of the examples of a secure place to put your money. Expensive. But
not anymore.
Yeah, well, let's get into that. I had the pleasure of attending your annual gathering that you have in Zurich. It started with a few friends and family a few years ago, and when I attended in the most recent summer, it was, I think, hundreds and hundreds of people in a very large sort of gathering space, conference hall. The Carbon Palooza has a festive atmosphere. Your annual conference, and so your company, obviously you have your project in Iceland and a much bigger one coming in the United States that's meant to be scaling up. But you did make some news a couple of years ago when one of your senior executives did talk about a price of $600 a ton. Quite frank admission, because your main competitor likes to talk about a much lower price, conceptually written in papers in Joule and other academic journals of how theoretically one day this could get down to $100 a ton. Don't ask what it is now, whereas you folks are taking a very different approach. And tell me where you've gotten to, and how does one think about the buyers, the people that are forking over cash to support you. It is something of an act of faith at this point, isn't it? They're buying into the future.
Yeah. Let me come back maybe at the beginning when you ask, okay, who is buying, right?
Sure.
And then I'll get back to that.
Sure.
If you look at today, the SBTi numbers, there's maybe 10,000 companies committed, right? Which means that they are committed to buy removal at some point. Today, we estimate maybe 200, 300, 400 companies buying in the world. Out of that, 40 only are buying more than 10,000 tons, right? So it's very small, right?
Right.
The total market today is 8 million tons sold. If you think about the minimum 8 billion we need to reach in 20 years, we're still not to those numbers. But there's one thing that is interesting in what we see since a year and a half, is that if you look at the companies that are a stage before, after having a green light from their board to do something, or already in pre-buying mode, that number is actually quite high, more and more. Okay, so what has changed? Why people are now more and more looking at buying? And I don't know how many are looking at buying this year, but what has changed? Two things that I can mention. One is, one of the insight we had, especially at those gatherings, is that carbon removal is not easy. It's hard to do. And there's a lot of, let's say, knowledge gap. That's because it's not kind of you're not smart enough to read the book, is you're busy getting the reduction done. So then you're not really looking at doing removal day to day. So there's kind of this knowledge gap. The second thing is the price. And should we look at the price or should we look at the value, right? Because we should also look at, okay, what is the business case, right? You cannot be climate smart only, you have to be business smart, right? So these are really the two barriers. So the way we worked, and that's why I think we see this big growth in companies ready to buy. We also decided, a lot of our early partners, we had maybe 100, 200 companies buying from us on DAC. A lot of them asked us, okay, we like what you do, we like your methodologies, we just don't know what to buy else. Because yes, you have a high price, you're permanent, you're the gold standard, but we want to know, if you use your methodology, what else should we buy? We know that you have experts for a long time in your company. You have, you have collected a lot of data across technologies, across, let's say, suppliers. What can you do? Can you help us? So without us really, let's say, looking for it, we started helping companies to really build their strategy, build their portfolio thinking, build their due diligence based on our model, and really helping them from strategy, purchasing, to the end.
Now, Hussein, can I just stop you for a minute? It sounds a lot like they're asking the fox to guard the hen house.
Sorry?
Why would you help them figure out how to buy another company's product that's cheaper and better than yours? It doesn't make any sense.
Look, we cannot scale if the company do not buy. We as in DAC.
But the only thing you can tell them is, we've done the analysis, we're the best, just buy us.
And that's not what we're saying, right? Because we need to beat on the science, right? And just look at it, right? if you build a stock portfolio in the you buy shares, you're never going to buy only from one, right? Even me, I have Climeworks shares, but I have other shares, right? You need to minimize your risk and maximize your impact, and we need all of them, right? I mean, like, let's also be realistic. You need all of the co-benefit of all of them. You need all of them to scale. Like, if you look at only Climeworks DAC, our ambition is 1 billion ton by 2050. The world will need 10 billion tons, right? So we need to scale everybody. So I think that's also one of the realization is if we want to scale, we need to help others scale, and we need to help companies move to the first step. And to be honest, that also kind of shows us that that's happening. And then the second thing is we need to show them this is not charity. This is not, when you pay 300, 400, 100, this is not charity. You mentioned the marginal cost of abatement. That's already an insight. We are taking care of the hard to abate emission. Hard to abate means it hurts because it's expensive and I don't know how to abate it. Some of those costs goes to 800, 1,000, 3,000 in some of the pharma area. Removals is much cheaper. So then suddenly you're like, okay, if you have to buy it, removals is already a smart financial decision. Now you need to answer the question of why now? And that's where also, back to what you said, there is always a reason to start early, but small, right? You're not going to fly tomorrow. You need to crawl, walk, run. And during those phases, you basically build internal knowledge in the company, build expertise. You can also build competitive advantage, right? You can really kind of secure future price in shaping the market. Right. So, this idea of, I always say it using a French word, a very gastronomic word, millefeuille. Millefeuille is a dessert. If you heard about it, build your first layer, right? Don't go to your CFO and say, I need 1,000 layers. Start with the first, give them the reason that this makes sense financially, and it will build the resilience of the process internally. So those two things made us kind of realize that the market is now bubbling.
Very good. Okay. I like your French dessert analogy.
Yeah.
And of course, we are seeing buyers, certainly the ones at the leading edge, are gaining both that internal knowledge, building that muscle memory, as well as striking deals, getting optionality. Because if
Yes.
this market does get crowded, the supply may not be adequate. And so getting in earlier, getting either better pricing or at least even securing supply might be very important for those companies that are serious about their net zero commitments. They want to be sure they get quality credits in future. So you explained very nicely what are some of the dynamics of leading edge buyers. Are any of you on stage seeing some form of advanced market commitments or coalitions of buyers making a difference? That's a phenomena that people talk about? I mentioned Frontier. There are others that are engaged in this sort of behavior. Either you or others want to talk about this a little bit. The idea of aggregating buying, and as we saw with pharma, of course, that was a great classic example of advanced market commitments with drugs for neglected diseases. But we're beginning to see this in climate technologies as well. Anybody want to chip in on that?
Well, go ahead.
No.
And I'll come to the audience in a minute as well. Yeah.
Like the consortium agreements that we have with virtual PPAs for electricity, we think that there is also an opportunity to team up and do that analysis because it's really a sea of information out there. And indeed, we are busy day by day to reduce. We don't have the in-house expertise, but we need to cooperate and find and cherry pick the projects that we can finance. And unfortunately, scale, so the larger you are, the more buying power you have, the more competitive the price can be. The biggest problem is why something that a project 5 years ago would cost 1/5 of what it costs today. Mm-hmm. While the farmer or the project manager on the ground is seeing a minimal increase in their costs. Somebody is picking up a big part of that uplift of the price. And that is a problem. So if you come with, let's say, a bigger wallet, you'll be able to press down the price to be as fair as possible. But again, you need to do the due diligence that the money that you put in, the yields and the biggest portion of it will go down to the project.
Great. Let's get a couple of questions in if we can. We've had a rich conversation. Somebody want to jump in with a question or a challenge for our buyers and trainers of buyers? We have a question in the front. Let's get a microphone up front.
Yeah, hi, Pim van Keep, SLB Capturi. I have a question about the quality of negative emissions. And biogenic sources can be from different industries, pulp and paper. Then you can say, okay, we do biomass, convert that to heat and power. And then we're sliding towards sludge incineration and then waste energy. And waste energy has 50% biogenic, maybe 65%. Is there a feeling around the quality of the value of such negative emissions in the voluntary market? Is it less, what do you say, less favorable to come from waste energy than it would be from pulp and paper? Is that an impact on
Yeah, it's quite interesting because we got this question literally 1 week ago internally. When we brew beer, of course, we generate CO2, biogenic emission, and they are back into the product. Today, we reuse 95% of the CO2 created into fermentation, and we never really look into carbon credit or certifying. We use most of the time we try to resell it into the industry for other industries. And our team was like, maybe we should look at it. What I understand is quite difficult on the permanence level. It's quite costly, and we are only brewers. We're quite pragmatic people, so that's something that we'll certainly look at it. One of the questions you have is about the quality and the certification. That's a bit what you can say. We are very busy on reducing, on doing our own business, brewing beer, reducing emission. So when you go into that world of managing biogenic emission or permanence of carbon, it's where you start to see that resource and knowledge is maybe not always available internally, but there is interest, and maybe we'll learn more in 2 years. I might be able to tell you more about that.
Just maybe briefly, important distinctions that would, as I understand it, fall under avoided emissions, which is a very different bucket for this entire discussion, as you pointed out in the beginning. The SBTi has created a clear distinction between these two types of carbon credits, and it's the vastly more expensive carbon removal, which is, I think, the market we're trying to scale. So I think there's value in it. I think there's a big question right now about business models for this, because a lot of the carbon market crises, or whatever you want to call it, we've had over the last 4 years, is particularly around the avoided emissions angle.
Please.
Yeah, just to add, I think, especially when it comes to carbon removal, I mean, we didn't add it like 5 years ago, but now in the last years, you see there are quite some registries that are developing protocols and methodology for certifying these credits, and some of them they're really granted on scientific knowledge, and they're quite robust. So the feeling, I mean, it's my personal feeling is that they're going in the right direction.
Do you see a light at the end of the tunnel from the current challenges?
I think there are at least I speak from the SBTi side, I think there's going to be very exciting development for CDR happening.
Okay. Hope springs eternal. Let's get a microphone here, please.
Hi, my name is Harsh Agarwal. I run a company called All Carbon. Just building on your point, Vijay, about culture and strategy, my question to Alexandros and to Nicola, there's a part of when you just on the board level, right? Sometimes you have certain board members who are just very excited about certain solutions. So they'll say that let's do it for catalytic impact. But when the reputation risk is there with projects, on the flip side, there are certain reputation benefits when you're also an advanced early mover on certain technologies or certain solutions. That was the case with offshore wind, maybe for CDR. So how do you actually think about or quantify reputation benefits that can also accrue from being first movers in this particular sector?
I start?
Yeah.
Yeah, I think it's an excellent question. And I think we've all gone through in our own corporates into this learning mode, into the board. If I reflect 7 years ago, I think there was every week, an email from a board member to say, hey, I found this startup and I found this. And I still remember we have a brewery in the Bahamas where somebody was selling us this kind of kite surf that was generating wind and electricity. And wow, fantastic idea, but we can't scale that. We have to be very, very strategic. So you have to go through that learning journey. You have to also assess. You cannot say no, of course, to any new ideas. But at one stage, you also need to close the door and say, okay, this is our portfolio. This is a technology we feel are right. We feel they are solid, scalable, robust, and capable to be certified with the right integrity. You also have to pick when you want to lead and what you want to lead. You know, if I take my scope 3, I have farmers, packaging, logistics, bars and restaurants with fridge. I can have business travel. But I have also to prioritize where is my biggest impact and where as a company we should play. We are one of the biggest buyer of barley. You know, it's one of our crops. This is where we're going to help our farmers. We are certainly one of the biggest buyers in the world of glass bottles. The green glass bottle, you cannot avoid it. You know, this is ours. You know, we have to play there. But we might not play on logistics. We might not play on, you know, on categories where other people are going to take care of that. And that's the same for CDR. You know, there is things today we say that, you know, we have a lot of projects in our own footprint that maybe on nature-based solution we need to focus because they also fit into our water strategy and biodiversity strategy. And there will be people, like you said, knocking on my door every event we meet to try to sell me his solution. And I might say yes one day. I don't know. Depend on the price.
Some others
Well,
say yes.
we're just out of time, but I am very much looking forward to our double zero carb Heineken that's coming. Better for your stomach, but also better for the planet. Please join me in thanking my panel for a wonderful session.
Thank you.